Hey guys, this is Dawson Discussions, and my name is Nathan L. Dawson Jr. This is technically it's part 3.2 to my video series of me reviewing the book Investing 101 by Michele Cagan, also with my commentary into it. And this video is going to be about chapter 3, but it's actually I split into two parts, so this is actually going to be about mutual funds. So here we go. Okay, mutual funds. A mutual fund is a type of investment vehicle consisting of a combination of stocks, bonds, and other securities. They are divided into several kinds of categories representing the kinds of securities they invest in, their investment objectives, and the type of returns they seek. Mutual funds charge an annual fee, which is called an expense ratio, and in some cases, commissions, which can affect their overall returns. The overwhelmingly majority of money in employer-sponsored retirement plans like a 401k goes into mutual funds. Investors can actually earn money through investing in a mutual fund in three ways. One way is income earned from dividends on stocks and interest on bonds held into the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of a distribution. Funds often give investors a choice either to receive a check for distributions or to reinvest the earnings and get more shares. Second way is if the fund sells securities that have increased in price, the fund has a capital gain. Most funds also pass on to these capital gains to investors in a distribution. And lastly, number three, if funds holdings increase in price but are not sold by the fund manager, the fund shares increase in price. You can then sell your mutual fund shares for a profit in the market, and those are the three ways investors typically earn a return from a mutual fund that they buy into. There are generally three types of mutual funds. The first and the classic one is called an actively managed investment fund. An actively managed investment fund is a mutual fund in which a manager or a management team makes decisions about how to invest the fund's money. Supporters of actively managed funds point to the following positive attributes. Active funds can make it possible to beat the market index. Several funds have been known to post huge returns, but of course each fund's performance changes over time, so it's important to read the fund's history before investing. Opponents of actively managed funds point to the following negative attributes. Statistically speaking, most actively managed funds tend to underperform or do worse than the market index. We only know how well a particular fund will do by reading its historical data. In reality, there's no way to predict how well any fund will actually perform. Every time an active fund sells a holding, the fund incurs taxes and fees, which will diminish the fund's performance. You'll pay a flat fee regardless of whether your fund does well or does poorly. If the index offers a 7% return and your active fund gives you an 8% return but charges a 1.5% fee, then you've already lost half a percent. A passively managed fund, by contrast, simply follows a market index, which is a hypothetical portfolio of investment holdings which represents a segment of the financial market. It does not have a management team making investment decisions. You'll often hear the term actively managed fund in relation to a mutual fund, although there are actively managed ETFs or exchange traded funds. Indexing is a form of passive fund management. Instead of a fund portfolio manager actively stock picking, bond picking, and market timing, that is, choosing securities to invest in and strategizing when to buy and sell them, the fund manager builds a portfolio whose holdings mirror the securities of a particular index. The idea is that by mimicking the profile of the index, the stock market or bond market as a whole, or a broad segment of it, the fund will match its performance as well. And that leads on to the second type of mutual fund, which is number two, also known as the index mutual fund, or you can call it the market index fund, or just simply an index fund, is a type of mutual fund with a portfolio constructed to match or track the components of a financial market index, which is a hypothetical portfolio of investment holdings which represents a segment of the financial market. So you can't really invest directly into an index. So you're just gonna have to open up a brokerage account and then invest into that brokerage account's fund that actually tracks that index. So John Clifton or Jack Bogle was an American investor, business magnate, and philanthropist. He was the founder and chief executive of the Vanguard Group and is credited to creating the first index fund. An avid investor and money manager himself, he preached investment over speculation, long term patience over the short term action, and reducing broker fees as much as possible. The ideal investment vehicle for Bogle was a low cost index fund held over a period of a lifetime with a reinvestment of dividends and dollar cost averaging. In 1976, Bogle founded the first investment trust, a precursor to the Vanguard 500 Index Fund, also known as VFNIX, as the first index mutual fund available to the general market. There's an index and an index fund for nearly every financial market in existence. The Dow Jones Transportation Average, or the DJTA, also known as the Dow Jones Transports, is a U.S. stock market index from the S&P Dow Jones indices of the transportation sector and is the most widely recognized gauge of the American transportation sector. The average was created on July 3rd, 1884. It is the oldest stock index still in use, even older than its better known relative, the Dow Jones Industrial Average, or the DJIA. The Dow Jones Industrial Average, or the DJIA, or you just call it the Dow Jones, or just simply the Dow, is a stock market index that measures the stock performance of 30 large companies listed on stock exchanges in the United States. Although it is one of the most commonly followed equity indices, many consider the Dow Jones to be an inadequate representation of the stock market because it's just 30 stocks. It is the second oldest U.S. market index after the Dow Jones Transportation Average, created by the Wall Street Journal editor and Dow Jones and Company co-founder Charles Dow. Another example of an index would be the National Association of Securities Dealers Automated Quotation, or the NASDAQ Composite Index. This is a stock market index of the common stocks and securities listed on the NASDAQ Stock Exchange. The composition of the NASDAQ composite is heavily towards the information technology companies. The Standard & Poor S&P 500 Index is a stock market index that measures the stock performance of 500 large companies listed on stock exchanges in the United States. It is one of the most commonly followed equity indices. The Russell 3000 Index is a market capitalization weighted equity index maintained by the Financial Times Stock Exchange, or FTSE Russell, that provides exposure to the entire U.S. stock market. The index tracks the performance of the 3,000 largest U.S. traded stocks, which represents about 98% of all U.S. incorporated equity securities. And then you also have the Russell 2000 Index, which is a small cap stock market index of the smallest 2,000 stocks in the Russell 3000 Index. And then you have the Russell 1000 Index, which is a stock market index that tracks the highest ranking 1,000 stocks in the Russell 3000 Index, which represents about 90% of the total market capitalization of that index. And lastly, you have the Wilshire 5000 Total Stock Market, or simply the Wilshire 5000, a market capitalization weighted index of the market value of all U.S. stocks actively traded in the United States. As of December 31st, 2019, the index contained only 3,473 components. So those are actually the well-known, or at least commonly followed index, at least for the United States. And then, of course, you have outside of the United States. So outside of the United States, you have the Morgan Stanley Capital International Europe, Australasia, and Far East Index Fund, or the MSCI EAFE Index, or the EFA, or the EFA Index Fund, which represents the performance of foreign stock markets of developed countries in Europe, Australasia, and Far East. Far East would be the most eastern part of the Asian continent, Eastern Russia, and Southeast Asia. You also have the Morgan Stanley Capital International Emerging Markets Index Fund. An emerging market economy is the economy of a developing nation that has become more engaged within the global market as it grows. Brazil, Chile, China, Colombia, Czech Republic, Egypt, Greece, Hungary, India, Indonesia, Korea, Malaysia, Mexico, Morocco, Qatar, Qatar, Peru, the Philippines, Poland, Russia, South Africa, Taiwan, Thailand, Turkey, and the United Arab Emirates, where the city of Dubai is usually accounts as an emerging market economy. And lastly, you also have the Morgan Stanley Capital International All Country World Index, excluding the United States of America, or the MSCI ACWI EX USA Index Fund. So, what are the pros of owning an index fund? Well, for one, it's ultimate in diversification. When you invest into an index fund, you're exposed to all of the securities in that particular index. The more stocks in a portfolio, the lower chance that one stock could cause a significant decline in portfolio value. You also have low expense ratios. With active management, you're paying for the possibility of outperformance. Expenses erodes your returns over time. There are fees associated with any investment, but over time, the fees you pay can really add up, which is why low cost index investing can leave more for your money invested for growth. There's also no human element, no manager actively managing the fund for those who don't want a whole lot of fees associated with it. Index funds usually have a strong long term return. By definition, index funds aim simply to track their benchmark indice before fees and expenses. Active funds, on the other hand, may well aim to outperform, but research shows that remarkably few can achieve it over time, making index funds the better performers on average. It is also ideal for buy and hold investors with a long term objective. Again, no manager is actively managing the fund, and for those who don't want a whole lot of fees associated with it over their investing career. And lastly, you are minimizing capital gains taxes. Tend to have lower turnover than actively managed funds, meaning they buy and sell securities less frequently, potentially generating fewer capital gains. So, what are the cons of investing into an index fund? Well, it's vulnerable to market swings and even crashes. If the index you are following crashes, so does your investments. The lack of flexibility, meaning that you can't control the holdings in that index. So whatever holdings that's in the index that you invest into, that's what you're gonna get. So if many companies in one index does really bad, then you can't sell those companies and then put new companies in place. That's not how an index actually works. Only if the companies doesn't meet the index objectives, and then of course the index creators, I think like Morgan Stanley, Capital International, they might take out a company, but you yourself can't do that because you're not, Morgan Stanley, Capital International, or Standards and Poor, or any index creator. And lastly, there's no human element. No manager actively managing the fund to beat the market should you want to beat the market. But those are usually the cons associated with investing in index funds. Okay, moving on. ETFs. Created in the early 1990s, an exchange traded fund, or ETF, is a basket of securities that trade on an exchange just like a stock, just like the name. ETF, exchange traded fund, funds that trade on the exchange. ETFs share prices fluctuate all day as the ETF is bought and sold. This is different from mutual funds that only trade once a day after the market closes. ETFs can contain all types of investments, including stocks, bonds, securities. Some offer U.S. only holdings, while others are international and some are sector specific. ETFs offer lower expense ratios and fewer broker commissions than buying stocks individually. An ETF is a type of fund that holds multiple underlying assets rather than having only one, like a stock. Because there are multiple assets within an ETF, they can be a popular choice for just diversification. So an ETF can own hundreds or thousands of stocks across various industries, or can be isolated into one particular industry or sector. Some funds focus on U.S. only offerings, while others have a global outlook. For example, banking focused ETFs will contain stocks of various banks across the industries. ETFs trade through online brokers and traditional broker dealers. An alternative to standard brokers are robo advisors like Betterment, Wealthfront, Wealth Simple, SigFit Wealth Management. who make use of ETFs in their investment products. Robo-advisors automate your investment management by using computer algorithms to build you a portfolio and manage your assets based on your goals and your tolerance for risk. An ETF is more tax efficient than a mutual fund since most buying and selling occurs through an exchange, and the ETF sponsor does not need to redeem shares each time an investor wishes to sell or issue new shares each time an investor wishes to buy. Redeeming shares of a fund can trigger a tax liability, so listing the shares on exchange can keep tax costs lower. In the case of a mutual fund, each time an investor sells their shares, they sell it back to the fund and incur a tax liability that can be created that must be paid by the shareholders of the fund. So, what are the pros of investing into an ETF? Well, for one, it's ultimate in diversification. Like a mutual fund, it's very diverse. When you invest into an ETF, you're exposed to all the securities in that ETF. The more securities in that portfolio, the lower the chance that one stock could cause a significant decline in portfolio value. You also have your low expense ratios and fewer broker commissions. Operating expense ratios or OERs for ETFs tend to be very low, typically lower than they are actually for actively managed mutual funds. ETFs also combine the trading versatility of individual securities with the diversified qualities of mutual funds to meet a variety of investment needs. And lastly, ETFs are tax efficient. They tend to have lower turnover than actively managed funds, meaning they buy and sell securities less frequently, potentially generating fewer capital gains. So, what are the cons of investing in ETFs? Well, actively managed ETFs have higher fees. Single industry focused ETFs limits diversification. And lack of liquidity hinders transactions. So an ETF's liquidity is based on a number of market makers, firms that stand ready to buy or sell throughout the trading day, interested in buying or selling ETF at any given point in time. So my take is that mutual funds in general are an excellent investment vehicle for diversification for your portfolio. For those who don't want to be active in managing their own portfolio or they are just starting out investing, I myself would recommend for them to invest in a few low cost index funds or to use a robo advisor like Betterment, Wealth Simple, Sigford Wealth Management that make use of ETFs in their investment products. Um, That would be my personal bias because I'm not a trader of assets and actively managed mutual funds have more fees. Uh, excuse me. Actively managing mutual funds have more fees attached to them, and statistically speaking, most actively managed funds tend to underperform or do worse than the current index. That and the tax implications on trading and actively managed mutual funds. So there's a whole lot of taxes as compared to for capital gains for an actively managed mutual fund should the mutual fund manager decides to sell an asset. Me personally, I'm currently using Fidelity's investment robo advisor for the Fidelity Go for a growth portfolio with an aggressive style of investing. I am investing in the S&P 500, which broadly represents the performance of the largest 500 common stocks publicity traded in the US. I also invest in the Russell 2000 index, which is the market cap weighted index designed to measure the performance of the small cap segment of the US equity market. I also invest in the Russell Mid Cap Index, which is a market cap weighted index of medium cap US company stocks. And I also invest in the Morgan Stanley Capital International All Country World Index, excluding the United States of America Index, for international market exposure. And also invest in the Bloomberg Barclay Municipal Bond Index. And I have about 1% in a money market mutual fund for a cash reserve in that portfolio. That and also I'm currently using an ETF through Robinhood. I currently have the Investico S&P 500 High Dividend Low Volatility ETF that pay dividends for an income generating portfolio to help supplement my monthly active income. And that concludes this video for me reviewing Investing 101 by Michele Cagan, and also throwing in my commentary here and there for it. Chapter 4 is going to be styles investing. So, again, this is Nathan L. Dawson Jr., and this is also Discussions. And chapter 4 will be styles investing. And thank you for watching, and I will see you in the next video. So, take care and stay tuned.